All right, let's talk about Conagra Brands. You definitely know their stuff. I mean, it's everywhere, right? In your pantry, your freezer. But here's the thing. Even though we all know the products, the stock, well, that's been a totally different and kind of uncomfortable story lately. So in this explainer, we're going to dig in and figure out what's going on. Is this a hidden gem or what?
And that really gets us to the heart of the matter. The stock is just trading at this rock bottom price. So you have to ask, right? Is this a huge bargain on a company we all know and trust? Or is this a classic value trap? You know, the kind that looks cheap but is actually signaling some really deep underlying problems.
Okay, let's just look at the numbers for a second, because wow, they tell a really clear story here. If you look at Conagra, that's ticker CAG, its price-to-earnings ratio is just way lower than its direct competitors. I'm talking about companies like General Mills and Campbell's. I mean, across the board, no matter how you slice it, the market is pricing this company at a massive discount. So our job today is to figure out why.
So, to get why it's so cheap, we've got to start with the bear case. Let's jump right in and really understand all the pessimism that's been priced into this stock.
First up, this number, 45%. That is just staggering. The company's own CEO called it a historic amount of inflation. Think about that. Over the last 5 years, their costs have skyrocketed by 45%. That has just crushed their profitability and put this immense pressure on their margins. And you know, just when you think, okay, it can't get any worse, a whole new storm starts brewing on the horizon. We're talking about potential tariffs on tin plate steel. Yeah, the metal they use to make their cans. This could tack on another $200 million in costs every single year. It's a huge external headwind that just came out of nowhere, and now they have to deal with it. So faced with all this, what's management doing? Well, they're making a really high-stakes bet. They're basically choosing to sacrifice profit in the short term. They're plowing money back into lower prices and more promotions, all to try and win back customers and get those sales volumes up. It's that classic pain now for gain later strategy. But let me tell you, it is a very, very risky move. And right here, you can see the immediate fallout from that big bet. This chart shows a pretty steep forecasted drop in their adjusted operating margin for the coming fiscal year. And this isn't just a little dip, okay? We're talking about a major, planned reduction in how much money they make. And that, right there, is exactly what has investors so spooked. And to make matters even worse, on top of this risky strategy, they've had some pretty bad operational screw-ups lately. I mean, we're talking about quality problems at a major chicken plant that forced them to stop production. And then they got totally caught off guard by a huge spike in demand for frozen vegetables, leading to shortages. These kinds of stumbles, they really shake investor confidence. It makes you wonder if management can actually pull off this complicated turnaround.
Okay, but that's the bear case, right? That's the dark and stormy side of the story. It's only half the picture. Because despite all those very real challenges, there's actually a pretty compelling bull case, a reason to be optimistic for a Conagra comeback. So let's flip the coin and dig into that now.
So, first thing to know on the bull side, this company is really focused. Check this out. Over 80% of their sales come from just two main areas here in the US, grocery and snacks, and refrigerated and frozen. So this isn't some crazy, sprawling global company that's hard to get your head around. Nope, it's a very targeted bet on the American shopper. And that bet is built on an incredible foundation of powerhouse brands. I mean, we're talking about iconic names like Birdseye, Marie Callender's, Slim Jim, you know these. They are the #1 player in single-serve frozen meals as a massive multi-billion-dollar category. And that brand strength, that market leadership, that is their single biggest competitive advantage, hands down.
Now get this. Even with all that pressure on their profits, Conagra is still an absolute cash-generating machine. Last year, they turned out $1.3 billion in free cash flow. That is huge, and it gives them incredible financial flexibility to do things like pay down debt, reinvest in the business, and, this is the big one for investors, easily fund that dividend.
And what happens when the stock price is super low, like we talked about? Well, the dividend yield goes through the roof. We're talking over 7.5% right now. Now, if you're an investor, this is absolutely critical. It literally means the company is paying you, and paying you well, to just be patient while they work through this turnaround.
Of course, anytime you see a super high yield like that, you have to ask, is it safe? Is this a red flag? Well, with a payout ratio of around 58%, the answer looks like a pretty solid yes. That dividend is really well covered by their earnings and their cash flow. That gives investors a nice solid cushion, even with that drop in profits they're forecasting.
So there you have it, a really clear conflict. On one side, you've got the bear case. It's all about rising costs and the risk they can't execute. On the other side, you've got the bull case, built on these amazing brands and massive cash flow. It really all boils down to one single thing. This is a high-stakes turnaround gamble. And this slide, I think, just shows that gamble perfectly. Look at what management is doing. They're actively selling off the old, kind of slow-growing, but really stable brands like Chef Boyardee. And they're taking that cash and betting on the future, on smaller, trendier stuff, like these fatty smoked meat sticks. They're literally trading predictable, boring cash flow for a shot at much higher growth. And that really gets us to the core investment thesis, right? If you invest in Conagra today, you're not just betting on frozen food and snacks, no. What you're really doing is placing a direct bet on this specific management team. You're betting that they have what it takes to navigate this super difficult time and actually pull off this really complex turnaround.
So it all just boils down to the one question that every investor has to ask themselves. After seeing all the challenges and all the potential, it just hinges on this one thing. Can they actually deliver on this incredibly ambitious plan?
All right, let's boil all of this down to the bottom line for you as someone thinking about putting your money here. Let's weigh the risks and the rewards.
In this quote, it just sums it up perfectly. This is what you'd call a contrarian opportunity, and that's just a fancy way of saying it is not for everybody. This is for a very specific type of investor, someone with a long-term view, a multi-year time horizon, and a very high tolerance for risk. The risk that, hey, this whole turnaround thing, it might not go according to plan. So here it is, the fundamental trade-off, laid out as clearly as possible. The potential reward, the bull case, is you get to buy these iconic brands and their huge cash flow at a super deep discount, all while collecting that massive dividend. But the risk, the bear case, is that you're betting against historic inflation, you're betting on a really risky strategy, and you're betting on a management team that has had some pretty serious stumbles lately.
And that's really where we have to leave it. You've seen both sides now. You've seen the bear case, the bull case, the problems, and the potential. So the final question, well, that's for you to decide. Looking at all this, does the potential reward justify the very clear and very real risk? Thanks for tuning in.